minimal as possible legally, obviously. So that requires some planning, some habit forming, and so that's the goal of this training, if you will, right? This educational video is really just to provide you guys with some actionable items to be able to take back home at the end of the night, in the mornings when you guys aren't out in area, and to be able to set you guys up properly. That's the biggest thing. At the end of this, you guys will get access to a free course that we've built specifically for the door-to-door space, right? Where you guys can jump in there. You guys will have little sections, right? I mean, it's probably breaking this video down a little bit more too, as well, or this training down a little bit more. But that way you guys have it all the time that you can refer back to. Here's how to establish an LLC. Here's how to establish business banking, business credit. Here's how to categorize your transactions. So it's a very in-depth course that we'll give you guys access to. You guys will get it for free. Plus an ebook. You guys will get access to an ebook, as well as a calendar to be able to book a call with our team, with either myself, Nate. We have a couple other advisors too as well that you can have a call with, that we can dive into your own situation. So if I could give you the pinnacle, or really rather what our overall goal is for all of our clients, is ultimately to help them increase their overall net worth. We're not your traditional CPA firm. We're not your traditional accounting firm. It is to increase your overall net worth. And we do that through tax strategies, preservation strategies, and growth strategies. So we go through it all, right? We really strive to be that one-stop shop because we know you guys need it, right? We know you guys are hustlers and want to make a ton of money and can go make a ton of money. So we want to make sure we save that money for you. We protect it by preserving it, and then we help you go and grow it. So that was a little intro. I'm excited to potentially get to work with you guys and to give you guys this access to this information. That's the main reason I started this company, was to provide more education and information when it comes to taxes and finance and business structure. So I'll hand it over to Nate, and he'll jump right in.
Solid. Thank you, Travis. No, I'm so excited. I'm already seeing some guys on this call that I not only that I recognize, but that I work with on a frequent basis. Like, I don't want to be calling out a million guys, but I'm seeing Nick hop on. I'm seeing Eli hop on, who I just talked with like 2 weeks ago. We've got a couple advisors, we've got a couple advisors that work with some of the other guys on your team, but it is fun to see my guys. So but yeah, I'll jump into it. I'm Nate. I was actually in door to door for a while. I was in rooftop solar before getting into accounting, finance, taxes. So I've been on both sides. I see now how much of a game changer it is when you do things right financially, because I've seen those people that can almost retire in 10 years after doing really well in door to door. And I've seen plenty of other people where they will spend 5, 10 years, they don't do things the right way, and they end up getting out of door to door and go work some W-2 job until they're the age of 65, 75, and they hate their lives because they didn't do things correctly. And so, the goal is obviously to where we can help where you guys can get the knowledge and the experience that you need to be able to preserve kind of what you're building in door to door, because you guys are in a really special spot right now. So I don't know if you guys are movie buffs. I'm a big movie guy, so there's a little bit of that throughout here. But I mean, as an overview, this is really how to create or how to reach financial freedom in 10 years. And it's in three steps. So the first step is going to be spending less than you make. And ideally, you're going to make more, right? Because who wants to take big cuts on what you're spending? You want to keep spending what you're spending, maybe even spend more. But if you're making more, then you're going to reach a spot where you're spending less than you make. And the reason that this is step number one is because a lot of the tax strategies that you will need to employ, a lot of the things that you do proactively throughout the year, will require some cash and require some capital. And so you want to make sure that you have the liquidity to do what you need to do. To do step two, which is save big on taxes. And the reason we focus so hard on saving on taxes when it comes to advancing net worth is because it's such a big part of your income. And Adam was talking about it a little bit in the beginning too. But it's the biggest check that you write at the end of the year. For a lot of people, especially, people kind of in your scenario, it depends obviously on what state you're paying taxes in, but a lot of the times it's anywhere between 20 to 40% of your income, sometimes 50, goes to taxes. That's literally half of what you guys make. And it's not coming out of your paychecks. Like you guys can make 100 grand in a year, take home, and then, April rolls around and you're writing a check to the government for, 40 something thousand bucks if you don't do things the right way. I don't even want to add up the math on how many deals that is. Plus, I was in rooftop, so I don't know exactly how your pay scale works. But and then step three is invest what you saved. Because if you can save that 20, 30, 40% in taxes and invest that, then you're going to be retiring twice as fast. You're going to be retiring with twice as much money. Or even if you're not even thinking of retirement, maybe you're thinking of buying a big house, buying a boat. I mean, I have a very similar outlook to a lot of you guys where I want to live it up as much as I can. I want to make the most of my life. I'm not thinking about retirement. And so if you're reinvesting what you're saving in taxes, you're going to be able to do that twice as fast. And that's because if you think of somebody who's really good with their money, they save or invest what, 20, 30% of their income? That's what they invest every month. What else? Like we've been saying it this whole time, but what else is 20, 30% of your income? Taxes. So if we can save that and reinvest it, you're going to be doubling the amount that you invest, doubling the speed that you get to a certain point that you want to be. So obviously spend less than you make is step one. Like we need that cash to be able to go do stuff. But this is kind of what you guys are going to be focusing on while you're on the doors for the most part. Because if you make more money, you don't have to worry as much about spending. But spending is always something that you're going to want to be worried about. And so when it comes to spending, the biggest thing that you can do is know your numbers. Because there's going to be a lot of leakage and a lot of opportunities within that. And I know you guys don't want to be looking through, your bank statements all the time, but it's going to be very valuable to know what's coming in and out of your bank account. There's a bunch of different ways to do it. And some leakage that I see a lot of people have when I'm looking through their finances and when I'm looking through their books and I see their bank transactions coming in is you'd be shocked how many guys are like good with their money. They're very good entrepreneurs, or they're these guys in door to door that are making hundreds of thousands of dollars. You'd think that they'd be on top of everything that they're doing, but they're paying like 150 bucks a month in credit card interest. They're just letting stuff leak. Or maybe they're putting something on their personal card when it should go on the business card, and they don't get a tax deduction from it, which we'll get into if that isn't making a ton of sense for you guys. So step one's pretty simple. Step two is really where we can deliver the most value and where you guys are going to make the biggest difference. And that's save as much in taxes as possible. And I'll kind of illustrate this with a little bit of a scenario. So let's say you're an individual, you make 60,000 bucks in a year. You say, hey, IRS, I made 60 grand this year, but I spent like $58,000 of that on survival, like living expenses, like rent, groceries, gym membership, things like that. And then they tell you that you're going to need to pay taxes on 60,000, even though you're only left with 2,000 because you spent 58 of the 60. Because that's how taxation works for individuals. Taxes work completely different for individuals than they do for businesses. Because for a business, like let's say Amazon goes to the IRS and they're like, hey, we made $100 million this year, but we spent 95 million in business expenses. So, I mean, we really only got to pay taxes on 5 million. Like that is not a fair game. Absolutely not a fair game. And there's reasons why the tax code is kind of written that way. A lot of it's lobbying, right? Because who's going to lobby the government? People that are wealthy, which are usually business owners. But at the same time, if a business spends money, a business is really only spending money to make money. And so the more that a business can spend to try and make more, the more it's going to advance the economy. So it's a positive feedback loop. But at the end of the day, taxation is not fair at all for individuals versus businesses. And this is really where a lot of people find themselves in some trouble is when they don't have the cash for their taxes because they had no clue what was coming up. They weren't planning, for what their tax liability was going to look like. They kind of just made money and said a prayer that things would be okay. Maybe they didn't even say a prayer. I know I wasn't saying prayers about taxes. But point is you got to plan this stuff out. And so where you're going to start is your structure and systems. So when it comes to systems, you can see this on the left-hand side, but you're going to want to act and transact as a business as often as possible because business expenses lower the amount of money that you're taxed on, whereas personal expenses don't. And you saw it in the last slide, but you can spend money for the most part. Now, there's ways where we can kind of help with a lot of this, but for the most part, rent, groceries, gym membership, like living expenses like that, they don't lower the amount of money that you're taxed on. They don't lower your portion of income that you're taxed on, but business expenses do. And so we need to start looking for ways where we can, where you're acting as a business rather than as an individual. And we'll kind of get into some of the specifics there. Another great way is separate personal expenses. You're going to want to keep, obviously, you're going to want to try and act as a business as often as possible. But when there's no way where you can say, hey, this is a business expense, then you're going to want to put that on a personal card and everything else goes on the business card. And then when it comes to structure, you're going to want to identify goals and habits and organize around those. So you can see this diagram on the right. This is, everyone's kind of got a little bit of a different picture. And this is an oversimplified version. All the guys that I work with that have a diagram like this, an organizational chart like this can tell you it's a little bit more complicated. Like we'll draw out where money's moving so we know where we need to house money so it's not taxed at a certain amount. But if you're able to identify your goals and your habits, we can organize around those. So then your structure is built out the right way. So maybe somebody wants to own some rental properties. Maybe they've got a family and they want to, preserve their wealth as much as they can. Maybe they would place everything under a trust. Maybe some other guys wouldn't feel like that would be the best thing for them to do. You can see Hobby Business LLC right here. This isn't something that everybody does, but there's a couple guys that you might know that do a hobby business. And the reason that hobby businesses are so big, and I'll give you an example of one, is because it's a way where you can take some personal expenses that are not reducing your taxable income and then turn them into business expenses where they do help lower your taxable income. It's money you're already spending a lot of the times. And this can be things like I have a guy that spends 30 grand a year on water skiing and he takes it pretty seriously. He's got like a sponsorship or two, creates a little bit of content. And so now he's pursuing income and has turned it into somewhat of a business. And so he can deduct 30 grand from his taxable income because it's now a hobby business. And so we want to take a look at what our plans are, what our habits are, and then we can organize our structure around those. What LLCs own what, if it's owned by a trust, if we have a holding company, and what assets fall under that. So that's where we start. And then when it comes to saving on taxes, one of the biggest ways where you're going to be able to find savings on taxes is deductions, which in short, for the most part, is business expenses. So these are places where you can find opportunities to transact as a business. Being in door to door, especially a area of door to door where recruiting's so big, and I really don't know that there is a door to door niche where recruiting's not big, right? But recruiting is one of the best tools to use to turn something into a business expense. I'll give you an example of this. When I was in door to door, I didn't live in area. I'm sure most of you guys don't like live in the market that you knock in. You might travel and you'll knock there. I'm sure some of you guys might live in market. At least for me, I didn't. So I live in Utah right now. I knocked in a bunch of different states over the years I was in door to door, but for the most part, if you're out an area, that's a business trip, so you can write everything off. You can deduct it as a business expense. But when I was at home and when I wasn't knocking, it's pretty tough to find deductions when you're at home. But even my gym membership, I would write off as a business expense, and I would use it as recruiting. So I would say that I was going to the gym to recruit guys. And so I would write off my mileage to the gym. I would write off my gym membership. And there were some guys that I did meet at the gym that came out and knocked with me. And I even had overrides from these guys on my pay stubs. And so I was completely able to back it up. But a great way to take something that you're spending and make it business is recruiting. You can even do this with dinners. Let's say you're going out with some of your buddies that maybe aren't in door to door. You can turn that into a recruiting dinner. Same thing with trips. So we got to be keeping an eye out for, hey, what can we categorize as recruiting? What can we categorize as business? Because that's going to help lower your taxes. Another one is payroll. If you just change the way that you pay yourself, instead of just getting paid into your bank account, If you get paid into your LLC's account and then your LLC pays you through a payroll processor, then you can deduct payroll as a business expense. Same thing if you have family members that are doing favors for you. You can put them on payroll and loop that money back into your account if you'd like, but you get a deduction from it. Business mileage, we already covered this one. You got to look for if you're driving around somewhere, you got to try and find an opportunity to categorize it as business because that mileage is going to reduce the amount of money that you're taxed on. You can deduct 70 cents for every business mile of your income. We already went into hobby expenses. Accountable plan's a little bit more technical. But one of the biggest tax saving strategies that we use, especially when it comes to structure, is the LLC S Corp dilemma. And I don't know how many of you guys have heard about an S Corp before, but this is why it makes sense. It's because you can see it right here, but you're getting double taxed right now if you're not an S Corp and paying yourself a salary. So when you have your LLC elect S Corp taxation, because an S Corp is just an election, but once you have your LLC elect S Corp taxation, you can choose between either self-employment tax or payroll tax. And they're really the same thing. They just have different names. They go to the same programs and it's the same percentage. It's 15.3%. But there is one key difference between self-employment tax and payroll tax. So self-employment tax goes on any self-employment income, whereas payroll tax just goes on a payroll. And I know those may not sound super different, but if you look at the diagram on the right, you'll see what I'm talking about. So if you're not an S Corp, let's say you make 100,000 in a year. After expenses, you're left with 100,000 of, take home income in a year. If you're not an S Corp, you automatically get self-employment tax, which is 15.3%. So 15.3% on everything you make, 100 grand, is $15,300. That's on top of federal and state. So you're going to pay federal taxes, which is going to be almost another 15,000 bucks. You're going to pay state taxes, and then you're going to pay another 15 grand in self-employment taxes if you don't do things correctly. And so the big shift is when you elect S Corp taxation, you're allowed to pay yourself a salary, and salaries ran through payroll. Salary, payroll, same thing, right? So let's take the same 100,000 bucks, but let's have 20,000 of that be salary. A small portion of your income is paid through salary. The rest, you just transfer from business checking to personal checking. It's the easiest thing ever. I do it multiple times a week. But that 15.3%, now that you're getting payroll tax just goes on a payroll. And so that 15.3% is only hitting the $20,000 salary rather than all of your income. And so the difference that it makes is that 15.3% of 20,000 is going to be $3,000 in payroll tax. And so instead of paying 15 grand in self-employment, instead you pay 3 in payroll. So by changing the way that you pay yourself and by having your LLC elected as an S Corp, you're going to be saving on 100,000 bucks, you're going to be saving 12 grand right off the bat. And this is a huge one that so many door-to-door guys miss. This is one that I miss. I overpaid in taxes for years. And most of my friends that are in door-to-door, it's the same scenario. Another big one, and you guys hear about this one probably online from entrepreneurs or from people talking about taxes, but depreciation. And depreciation's magic because it's money you don't actually spend. But this is a similar outline from before, right? Where you want to know your numbers, you can see what you spend through the year. So if you take a look at this revenue, this is what you bring in, this is what you're paid, 140. So let's say you make $140,000 in a year, and then you're going to have some expenses out of that. So maybe you're paying commissions, maybe you got some recruiting expenses, travel, food. That would add up to $60,000 of expenses. So you've got $80,000 left to work with. If you have any assets that you own, so real estate, vehicles, equipment, you can depreciate that. And that would give you an on paper expense. And so this is where people are talking about, hey, I made this much money on paper. In real life, they made more money than what it says on paper. But the idea is you want to make your paper income look a lot lower than your real income because you're taxed on your on paper income. And depreciation is a way to do that. Depreciation is a phantom expense. So what that means is it's obviously not money that you actually spend, but it's things go down in value over time. So, a truck, maybe it's not going to be worth $100,000 forever. And so you can take depreciation on that truck, and that's essentially for the expense of the truck over a long period of time, because you're going to be spending 80 to $100,000 on that truck over a long period of time, but maybe you only give it a down payment of 20,000 bucks. So that's a way for you to spend a smaller amount, but you can take a bigger deduction on your taxes. Here's some things you can depreciate, and you would need to depreciate them as business vehicles. But real estate is a huge one, because there's a lot of value tied up into real estate. I know a lot of guys that look for vehicles that are over 6,000 pounds. They don't always have to be trucks. I know Travis, he's got a Porsche, and the Porsche is not a truck, but it's a hybrid, and so with the battery, it's heavy enough where he can depreciate it 100%. It's over 6,000 pounds. Toys are a big one too. If you can deduct these and depreciate these through a hobby business. So I don't know if any of you guys are riding around in Ducatis, or if you guys are into razors or side by sides or anything like that. But a lot of these toys that you guys are going to be getting, the longer that you're in door to door, we can depreciate these, and they can make a huge difference on your taxes. Okay, so now that we saved a large amount in taxes, step three is going to be taking that savings and investing it. And this is really what makes those savings go a long way. Because you're going to be saving, if you do things correctly, you're going to be saving tens of thousands of dollars every year. And if we can reinvest that, that's going to make a massive difference by the time you guys are older. Here's a list of some of the investments that we help with. The way that we help a lot of our clients with investments, and you guys are going to need to be, those of you that don't work with us, you're going to need to be looking for ways where you can look through different types of investments. I know plenty of guys that invest in one asset class that other guys wouldn't touch. So you really got to know what you want to look into. But real estate's huge. I know some of you guys maybe have some connections in life insurance, but IULs are a great thing to get into, especially if you want to get into infinite banking. Retirement accounts, if you use retirement accounts the right way, you can get big tax deductions. And obviously, people say the market goes up 10% every year, and 10% every year, that's going to compound. So that's a good investment anyways. Depreciable solar is a cool one. I don't know how many of you guys have heard about depreciable solar, and then RV parks. So we've got a bunch of different ones. I'll start with the retirement account. So I don't know how many of you guys have ever had a 401k before with like a employee type job, because you guys are working as contractors right now or solopreneurs, right? For royalty. But for W-2 employees, they get a 401k. So it's just a retirement account through their workplace. They can have money from their paycheck going into their 401k. And then the company that they work for can also put a little bit of money into it as well. It's called an employer match. Not many employers do it as much these days because, they're cheap. But either way, employers can put money into your retirement account, and it counts as a payroll expense. And any business expense, like we talked about before, lowers the amount of money that you're taxed on. And so the idea with the solo 401k is, now that you're the employer of yourself, you're self-employed, so you're the employee and the employer. If you have your employer, which is your business, put money into your investment account, your solo 401k, then that's a business expense on the business side, and then you get to invest. When you invest on the individual side, you do not get a tax deduction from it. But when you invest from the business side, it's a business expense. So you get to, like, let's say you put $69,000, which is the max, in a year into a solo 401k. Now you're taxed on $69,000 less than you would have been initially. So this one's huge, especially if you guys are already investing in things like stocks, crypto, ETFs. I don't know how many of you guys are excited for the SpaceX IPO coming up here, but for any of you guys that are into stock market type of investing, you guys are already investing this stuff. But if you have your business do it, then you can save so much more on taxes. If you invest up to the maximum, you're gonna save anywhere between $15,000 to $20,000 in taxes every single year. And if you're reinvesting that tax savings, this is what the difference is going to look like. So I don't know how many of you guys need to zoom in, but this is going to be huge. So on a 10-year comparison, if the market's going up 10%, let's say you invest $54,000 every single year. So maybe that's, a couple thousand a month, but you do it for 10 years. At the end of the 10 years, you would have 860,000 bucks. And you would save about $15,000 in taxes by doing that. So let's take that $15,000 of tax savings and let's invest that too. So if you look at this bottom one right here, with an extra $15,000 in tax savings reinvested, now we're up to the maximum of 69 a year. And now instead of having 860,000, now you're at 1.1 million. So it's a $240,000 difference by writing off your investments through a 401k, by reinvesting your tax savings into an investment account. And this is just with stock market type of investments. Obviously, this is the idea with other investments as well, like real estate. Whatever you save on taxes, you're going to want to put that back into your investment portfolio. Real estate's a great way to build wealth because you can have somebody else pay your mortgage. You have a mortgage on that home, and then somebody else's rent is going to pay that, and then that's increasing your net worth. You're building equity on that home for money you're not necessarily spending. And then you get giant tax benefits from it. So, but a lot of people don't get into it just because they don't know exactly where they, where they want to start or where they want to go with it. So, step one of getting into real estate would be identify an ideal outcome, meaning what do you want your investment portfolio to look like? Some people maybe they want some investments that are hands off and they don't want to, be a landlord. So maybe they would find something like a real estate syndication, which is where guys pool money together and they go into an investment together. Something like a multifamily property or an apartment complex, guys will pool money together and go into an investment. So if somebody wants something hands off, that's their ideal outcome, then maybe they, look for syndications. Maybe somebody, wants to go into something like short-term rentals, so they want to get into Airbnbs. So identify your ideal outcome and figure out what you want. Do you want cash flow? Do you want appreciation? Do you want tax benefits? And that's going to kind of narrow down the type of investment that you're looking for. Step two is network, 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 because, and realtors are super easy to network with. They're always trying to network with other people. But the more people that you know, the more deals you're going to find in any aspect. So this isn't just real estate, but especially real estate. The more investors you know, the more realtors you know, the more wholesalers you know, the more you're going to see deals that fit more of what your buy box looks like. So maybe you're looking for something that cash flows at least 500 a month, something that's going to appreciate, and something that's going to save you tens of thousands in taxes with not having to put much effort into it. And so the more people you know, the more deals you're going to find. And then ultimately, I mean, you got to pull the trigger. It can't be a should. A lot of people see investing as a should. Hey, I know I should invest. I know I should look for a property. And then they do what I call a should all over themselves and they don't end up doing it. And so the switch that you need to make is you need to turn it from a should into a must. I must invest so then my family can be financially free. So then I can reach my goals. So turn it from a should to a must, pull the trigger, and we'll get there. I'll let Travis cover this one because Travis is a banking wizard when it comes to financing. I mean, nobody touches Travis. So I'll take it on this one.
Yeah, so to hopefully stop yourselves from shooting yourself, these are ways to qualify. I love that. I actually haven't heard that before, but
Tony Robbins.
there you go. So the big question is how to qualify, right? In this space, everybody gets confused on, hey, how do I not pay money in taxes but still qualify for a house? And it's not as complicated as a lot of people lead on. Mortgage brokers, yes, they want you to be able to qualify very streamlined through an FHA loan or through something simple where you just send them your W-2s, you send them your tax returns, they go look at your income, boom, you're qualified. But the strategic mortgage brokers, the strategic lenders will open up a lot of different options for you guys. So seller finance is one, and this doesn't even have to do with a mortgage broker, a couple of these. So seller finance and subject to financing. That means you're working directly with the owner of the home, right? Sure, you can have a real estate agent involved, but generally you don't really need a real estate agent involved either. Now, Nonetheless, we are connected. We have a network of relationships and partnerships with real estate agents, with mortgage brokers, with lenders, with creative financiers to help our clients and facilitate these type of deals. So just these are a couple options here that we have, but and that we can help you obtain. But I wouldn't cut yourself short by not thinking you can get a property until a few years down the road where you've built up your tax returns and you've paid enough taxes. That's not the case. That's definitely not the case. There are just six ways right here. I mean, a 1099 bank statement loan, a lot of people haven't even heard of, but that's just where we look at your bank statements, send them to a mortgage broker, they add up how much you made, and then that's what you can qualify on. We don't even need to send them your tax returns. If you want to buy an investment property, we can go the DSCR loan route, which is a debt service coverage ratio loan, right? Which allows us to just use the rents of the property that you want to purchase or the market rents of that property you want to purchase to qualify you for the mortgage, right? So, and again, you don't have to send your tax returns. You might have to send a screenshot to show that you have enough for the down payment. But if I could drill anything home when it comes to investing in real estate, it's that you don't need to pay taxes in order to invest in real estate. That is a myth. And ultimately, if that is the route we want to go, we can show a bunch of income on your tax returns and then go back and amend the tax returns, right? After you qualify for the house and get into the property and everything like that. Like there's ways to do it where you don't have to show income on your tax returns and be taxed for it. So just remember that when you're thinking about investing in real estate, if you have an idea of investing in real estate, again, you do not have to pay taxes. And we'll walk you through specifics, right? That's what we do with our clients is as we walk them through specifics, what's just like Nate mentioned on the previous slide is with our clients, we'll identify the ideal situation and the outcome and what you want to accomplish and then again with our clients we build it out for them. Hey, this is how we're going to do it. This is the route we're going to go. This is how much it's going to cost. This is what the return is going to be. This is what the tax savings is going to be. Right? We walk you through all of that. So yes, a lot of ways to qualify. Thanks, Nate.
Solid. No, good point there on the amendments too. A lot of people think that when it comes to taxes, the only thing that you can do anything about is a year that has not finished yet or the year that we're on. But I mean, it's pretty frequent that we're amending taxes for people that maybe left some money on the table for a previous year. And if any of you guys have been in door to door for longer than a few months, I mean, I'd be willing to bet that you guys left a couple $1,000s on the table in taxes for a previous year. So I would say look into amending those and deducting the business expenses that probably were not deducted or depreciating something that probably was not depreciated. And usually within 8 to 12 weeks, the IRS is able to wire you a tax return from a previous year. I mean, even if it's a couple years back. So, good little note there on that, Travis. But when it comes to real estate, just to give you guys a little bit of a picture of like how it would play out if you actually invested in real estate, is if you accelerate the depreciation. So year one, you would see on a property like this, because obviously the numbers are different for every property. But on a property like this, if you guys speed up or accelerate the depreciation on this property, you would save 20 to 40,000 bucks in tax savings. A good rule of thumb is if you do accelerated depreciation, you can deduct a quarter of the purchase price in the first year in depreciation. So for a home like this, it'd be about 30 grand. But I've seen some come back a lot more. I've seen some come back a little bit less. So it's kind of a rule of thumb, but for a property like this, you'd save anywhere between 20 to 40,000 bucks in taxes in the first year. And then every year after that, you would still have a little bit of non-accelerated depreciation. And so you'd save, maybe 3,000 bucks in taxes every year that you have the property for the next almost 30 years. And then, like I was saying before, the good scenario is somebody's rent is paying off the mortgage that you have on that property, and you're building equity with somebody else's money. And then with the tax savings on top of that, I've seen a lot of people where they can almost get their entire down payment back the next year on taxes. And so in a scenario like that, you're almost buying a house for free, and somebody else is building your net worth with their rent payments if you structure it correctly and if you get enough back on your taxes through accelerated depreciation. Travis, you want to run through this one? You're the one that set it up, so
Yes. No, sorry. Let me unmute myself. So,
you're good.
so that's that was pretty much the end of the educational side, right? So I want you guys to take this call. You guys will have access to it. We recorded it, Adam recorded it. And so really take this, the QR code on the right-hand side, that's the free course and the option to schedule a call. So if you're on the individual, if you're just looking at it on your phone, you can take a screenshot of this and you can go back and just hold the QR code and it'll take you to the form, to the website where I introduce the course a little bit, kind of explain it. And the left side is just an ebook, a PDF file of an ebook that we have there. But again, take what you heard on this call and what's on the course and build your foundation. Okay. I can't tell you enough, whether this is your first year, whether it was, I heard in the beginning it was your first week, right? And you crushed it, or this is the first time you ever sold and already made 5K or something like that, right? That means you're going to be crushing it in the future. Whether that's you or whether you've been in the industry 5+ years. Okay. I can't tell you how many people I've had conversations with and clients that we now have that have been in the industry 5+ years that have not had a foundation set up. Okay. So set up your foundation, LLCs, right? Business bank accounts, structure yourself properly. Once you have that set up, then yeah, hop on a call with us, right? Or if you're making over, 80 to $100,000 a year, then schedule a call with us. You're definitely leaving money on the table, whether it's in taxes, whether it's investments, whether it's just having a strategy and a partner just to have strategic conversations with. Okay, so again, screenshot this, scan the QR code, download the course. There's only 5 videos. Again, it's a course that we've built specifically for guys in the door-to-door space, right? It's not this try and upsell funnel thing or anything like that. There's nothing you have to pay for. Again, we've built it for relationships like this that we have with Adam and the Dockmans and with other big sales organizations and companies. This is just free for you to build a solid foundation for yourself. Um, if I got to end with just the average tax that our clients pay is about usually less than 3 to 5% of what their top line take home is, right? So whatever their revenue is, it's usually about less than 3 to 5% of whatever that is. So they make $100,000, they bring in $100,000. Their taxes at most are like 3 to 5 grand. Okay, so lots again of opportunity there to save money in taxes. So we'll send the links for these two as well, so that way you guys have access to this. Um, but yeah, appreciate you guys' time and appreciate you letting us hop on.
Thank you, Travis. Thank you, Nate. That was good. That was solid.
Oh, thank you.
Yeah, I had like 3 questions as we were going through it, and by the time we got to the end of it, they were already answered. So yeah,
Oh, good.
you put it together well. You put it together well. You guys, opening for questions. If not, it's totally fine. I can close this out.
We got
That's what we
time.
do.
Yeah.
Don't
Cool.
want to keep guys off the doors, but yeah, we've got time for a few.
Okay. Yeah, we can limit it to, yeah, we'll take 4. Um,
Sounds good.
Hickman.
I had a question for Mr. Nate regarding writing off business miles. So, what is the best way to track your business miles? I know there's apps, I know there's bookings. Like I personally bought a vehicle just for this job and just for traveling. So I've been just like punch marketing like every time I make a trip. Like I don't know, like is that like good enough? Like if I get audited, am I just gonna get like ramsacked?
Well, here's the thing, unless you're making millions of dollars and writing off millions of dollars on things like McLarens that are not close to business expenses, then you're not going to get audited. You might have the IRS question a couple deductions, but I mean, if they're going to send an IRS agent out to you, there's got to be enough on the table. So I wouldn't say fear getting audited. Another thing too, if the IRS was contesting business miles and you have, like, let's say you have on an app that you drove 40,000 miles in a year, which a lot of door-to-door guys are hitting around 40,000 miles, especially if they're the ones driving out to Hood. But how would they be able to tell if how many of those 40,000 miles were going to the grocery store versus going out to area? They're not able to tell. So miles are tough to nail down and tough to be 100% accurate on. And I know a lot of guys that don't even like using the mileage tracker apps. There are some good ones like Mile IQ. I don't know if that's what you're using, but if you do want to track miles, I would say use an app for it. But what most of our guys do is they just ask themselves what percentage of their driving is for business. And if you're in door to door, a lot of the times it's like 80, 90%. And then just look at your mileage from January to December and then take 90% of that. And then you'll tell your tax guy, hey, this is what my business mileage was. And so, like, let's say you're driving, let me do some math. Let's say you hit 40,000 miles in a year and 90% of that's for business. I'm going to do times 0.9. So 90% of that's for business. That's 36,000 miles. And then you'd have another 4,000 for personal. And then, that's how you find out what you need to deduct without punching something every time you hop in the car. So I'd say just take a percentage. So that's a fantastic question. No, thanks for asking that.
Awesome.
What else we got? I see Harrington on here. He's got his questions answered.
Oh, yeah. How we doing?
Dude, it's good to see you.
You too. There's a lot of guys on the call, and at least on our team, that are running like recruiting trips, incentive trips for guys on their team if they hit a specific quota and they're going to be like paying for their costs to go on a vacation, leave the country, do all that. Is there anything that'd be good for them to note when it comes to their taxes with documenting the trip or anything of that nature for these big incentive trips they're running?
Yeah, that's a good question. I would say you can document it however you'd like, that it's a incentive trip. So whenever, I mean, you can, depending on who pays for the trip, if it's you that's paying for it, then you can like have a memo on your bank transactions and maybe I would say take plenty of pictures too while you're there. And then I don't know how you guys are tracking things on the leaderboard, but I would say maybe tag some of those deals as incentive deals towards a certain trip. So the only time that a expense like that, like let's say you write off 20 grand for a incentive trip that you go on, and the IRS is like, hey, I'm confused on what's going on. Please back up this deduction. Usually they send you something in the mail to send for you to return documentation on why you took a deduction. Then you would be able to have like photos and you would be able to have pay stubs and things like that showed that you paid for other guys' trips and you paid for those trips because of work that they did, because they hit a certain goal. So I don't know, Travis, what would you add to that?
I would set up an agenda. I think that's the biggest thing. Prior to going out, actually just documenting agenda, just a Word document in your notes, wherever it's at, just have an agenda there, right? That's the biggest thing when it comes to implementing tax strategies or to tax deductions is again being proactive and being purposeful when you're doing something, not retroactively being like, oh, I went on this incentive trip or this vacation, but it was a tax deduction, right? Go out there with the mindset of like, okay, this is a business trip, is what we're doing. This is why. These are the conversations we're having. These are the presentations. These are the trainings that we're doing. Again, it takes 15 minutes. Plug it into ChatGPT or Claude and say, create an agenda for this incentive trip. The agenda is going to be huge.
Yeah, that helps.
Love it. What else we got?
Yeah, and I know you had the hand up. Are you good?
Oh, we're good. Thank you.
Cool. I got no other hands. Maybe it's just my ego, Nate, but whenever I have no hands at the end, I just assume I nailed it. All questions answered. All questions answered. So I'm gonna go with
wasn't
that you
able to
guys
get
nailed
my
it.
That's a
hand
good way
up.
of thinking. That's a good way of thinking.
I have a quick one. It's about when you're investing in your personal accounts through the business. Is that as simple as just using your business card on your personal brokerage account?
Um, it depends. It depends on how you categorize things at the end of the year. What we have most guys do, because there's like taxes are so complicated and investing is so complicated. Like there's over 100 different types of certifications that you can get when it comes to investing, and there's multiple when it comes to taxes. What we've had most of our guys do is we connect them with a financial advisor or a self-directed IRA partner, and they set it up with somebody that does that as kind of their full-time gig, and then we get a tax form at the end of the year. But Travis, would you have anything else to add to that as far as like getting a solo 401k going?
Whether it's a solo 401k or like a brokerage account, like you mentioned, yes, I would use your business bank account or your business debit card whenever you're trying to set that up, just to make sure things are categorized like Nate was referencing and structured properly. And again, the advisors or the individuals that you're talking to help set that up will ask you for that information. And something like that is broken down in that course that we have for you guys too as well. So um yeah, if I can, look, we want to speak to you guys, right? All of you guys, I think there was almost 200 guys on this call, 200 individuals on this call. You all have individual situations, right? So we can literally guarantee you guys will save you more money on your tax bill, no matter what situation you guys are in. So again, being proactive, download the course, right? Build that foundation. I cannot reiterate that enough. And I know Nate's seen it. I know Adam's probably seen it being in the industry for so long, right? Guys come and go. And and I think just being structured properly, you guys will see a huge benefit. But schedule that call. You'll get connected with Nate. Nate, you'll jump onto his calendar or mine if we overlap. But again, we're here for you guys to answer your questions, to dive into your specific situation. So we're here for you.
Boom. Cool.
Got a last question. I don't know if that was four. I think maybe I counted three.
Yeah, we got one more.
We can do three too if we don't have any more. But if we got one more, we're ready to roll.
I think they're good.
Do I tell my old CPA that I'm switching up?
You don't have to tell them. You don't have to tell them. They don't care. They don't care. You email them and say, "Hey, I'm using somebody else." Okay, where do I send your docs? Right? It's weird. It's
They
definitely
don't
weird.
make enough for a tax filing fee. Like most CPAs are making like they charge like $500 for tax filing for like hundreds and hundreds of people. So it doesn't make a huge difference. It's kind of a convenience thing. Like they do a job for you. Some guys may even be like relieved. Like I know plenty of tax accountants that just do tax filing. They're like, "Oh my gosh, dude, another tax return." They just hate doing it. That's why I like doing the tax strategy and the investing side of things. Like I could put a tax return together if I wanted to, but I get to hop on with cool guys. I get to build out and strategize with them for like what their org structure is, how we're gonna like I just got off with a guy too that's in pest control. His tax bill was 65,000 bucks. We got it down to two, and we're planning some investments for later on in the fall. That's not how it's going to be for everybody. Like he's already got some assets that we can depreciate, and he just did an S corp election. And he makes a ton. Like if you're having a tax bill that high, there's a lot that we can save you. If you're not paying taxes at all, there's not a ton of work that we can do. But we get the fun side of it. So I mean, dude, he may even be relieved when you hit him up and say, "Hey, I'm gonna have somebody else, file." But even if you like the guy that's filing for you, I mean, obviously we'd love to file your taxes, and it's easier if we have a full picture of what's going on in your world. It's easier for us to just file off that rather than have two different parties. But I do have a couple consulting clients where they strategize with us. They plan taxes throughout the year, meet with us on a monthly basis to plan stuff, and then at the end of the year, we just give a report to maybe a family friend that files taxes for them. Because that's our main focus. Because tax filing isn't what makes the biggest difference in your taxes, and it's not what increases your overall net worth, which is obviously we've said it before, is our main focus. So dude, just send him a text or an email if he's older, but.
Thank you so much, guys. We appreciate it.
Yeah, this was huge. Thank you.
Nick. Solid, cool. Well, I think that might be all that we have for the team. We're at 9:57. Looks like a lot of you guys got to get hopping on the doors. So we'll toss it back over to Adam and Nick and get rolling.
Awesome. Yeah, I don't have a whole lot for you guys above and beyond that. Like I said, these calls are going to get bumped an hour earlier. Just in general, though, you guys, we're 13 days away from summer solstice. Like the summer solstice is the longest day of the entire year. Like if we're talking about the best season for you guys to be out there, like this next 13 days are the longest days that you guys are going to have throughout the entire year. These should be the biggest days. Like you guys have the ability to have in 13 days, an extra half hour on the doors, getting into 9 o'clock, getting into 9:30. Some of you guys are going to be out knocking till 10:30 at night. You guys are going to be able to stack some of the biggest days that you guys have ever had. So I'm expecting some crazy fucking checks for you guys, as we're already seeing. And yeah, let's go crush this fucking week. I appreciate you guys. Let's go.
Thank you, Adam.
Thank you, Adam.
Peace, everybody.
Thank you, Adam.